This webinar is going to speak about who we are, what our clients want to achieve, the key mistakes expats make when it comes to financial planning, key opportunities for expats and internationally minded people. Also, this is going to be a key point, why portability for expats and internationally minded people is essential, not just for return on investment, but also for managing risks and hassles. So who we are. We help expats and high net wealth individuals, but we also have many expats who return to their home country and those who want to invest internationally. We have clients in 109 countries and across all the major regions, including in Africa. Some of our clients already have advisors and some are new to investing. Entities and staff are in numerous places and they have different specialisms. So some of them are focused on British people, some North Americans, others are focused on East Africans, others Indians, and so on and so forth. Some have product specialisms as well. And we're regularly featured in the media, CNBC, CNN, and beyond. Now, our clients work for all different kinds of companies, but we do have clients in all these major companies, but we also have many self-employed people, many people in companies that aren't multinationals as well. But here is a small selection of where our clients work. Now, more importantly, what do our clients actually want to achieve? So obviously there's many things here. Retirement is an obvious one. Passive income or financial freedom via an investment portfolio is another. Planning for children's education abroad, because if you plan to send your kids to America or the UK or the Eurozone, some people want to save and invest in that currency. Wealth preservation and protection, so insurance, trusts, foundations, and so on. So never being poor. Second residencies and passports, portability of assets, and that's going to be a key theme of this webinar, and I'm going to speak more about that later on. More safety compared to banks locally or back home. This is especially important in those countries that have had a banking crisis, but more generally, it's important. Second residencies and passports, I've already mentioned that. Gaining more liquidity if somebody's asset rich and cash poor. So some people have property and land and business, but they don't have a lot of cash. Some people want to borrow against their assets or they want insurance, something that will create liquidity. Diversification of currency and other risks. Getting money into hard currency internationally, especially if capital controls have came in or people are worried about capital controls coming in. Moving capital out of places with restrictions, such as Nigeria. So some people are interested in killing two birds with one stone and moving money out of their country, but also, investing at the same time. So what are the financial challenges that expats face, but also internationally people or internationally minded people, should I say more generally? So former expats, people who might move in the future. So first of all, moving around a lot means some banks and brokerages won't accept your account. So if you're British or Nigerian or Canadian or whatever, and you keep moving around, if you tell your bank you've moved, which is always a good idea, they might close your account. I'm going to speak more about why you should tell your bank that you have moved later on. Higher costs due to international schooling, insurance, and other expenses. Obviously, sometimes expats get that as part of their package, but if they don't, then even if you're being paid more, there's higher costs. Now, this is going to be a major thing, not being part of your country's social security system and fewer compulsory savings. I'm going to speak about that in more detail in the next few slides. Currency risks, of course, especially if you're paid in, the local currency. Getting money out of certain countries such as Nigeria, we did touch on that. Now, what are some of the biggest mistakes that I've seen expats make? I've been advising expats and high net worth individuals now for over 10 years. The first mistake people make, I would say, is not realizing something which is quite crucial. And that's that ultimately, back in your home country, your disposable income might not be high. However, there's so many compulsory savings. What do I mean by that? Take the UK. Even if somebody's got very little money at the end of the month, they're paying international insurance, which is like a government scheme which will pay for some of your retirement costs. Many people are in auto enrollment when it comes to their pension, when it comes to like a private pension. And even if they're not, most people have a mortgage. So that means that even people who are prioritizing their retirement and even people who are quite cash poor, they do tend to build up a portfolio pot. So in terms of the UK government's official statistics, about 1 in 4 people will have £1 million or more in their pension pot by the time they retire, just because you're adding and adding and adding from a young age. So even people who feel relatively, I wouldn't say poor, but certainly not rich, are actually building up their assets quite nicely. In comparison, in foreign countries, especially if you move as an expat, sometimes you're paid more, sometimes you get paid more and have fewer taxes, and sometimes even you'll have certain benefits like schooling's paid, drivers and other benefits with good expat packages. Cost of living might be lower. However, then you have to be quite disciplined in terms of investing. I've met so many people who are on really good expat packages in relatively low cost of living countries, but they don't save and invest because there's nothing compulsory. In other words, you're paid more in some cases, more benefits, or lower cost of living, or all of the above, but then you have to save and invest for yourself. And that's a key thing. So I'll give you an example, right? Take two people. Let's say you've got an international school teacher and a school teacher back home, or an oil and gas worker back home and one who is overseas. A school teacher in the UK is going to get the state pension. They're going to get a really decent teacher's pension. Same with an oil and gas worker who's with BP or Shell. They're going to get a good company pension if they're just a staff worker, and an old age pension. But overseas, it is true to say that international school teachers and some oil and gas workers are living much better lives and have higher, living standards. However, if you don't use some of that money to actually save and invest, you're going to be behind in retirement. So I saw something interesting on LinkedIn where somebody said, and this image really sums it up, that when it comes to international school teachers, many teachers back home think that the international school teachers are rich because they can go on loads of holidays a year, blah, blah, blah. That might be true, but that doesn't mean in retirement you're going to be better off than those back at home. So to put this in mathematical terms, the average person in, say, the US or UK or Canada who's going to have at least $40,000 of income per year in retirement, that's about the equivalent of $1 million that you would have to have in your investment pot if you're doing it by yourself. Likewise, let's say if somebody's got $60,000 a year of retirement income back home, you're probably going to have an investment pot of $1.5 million to safely withdraw or have a safe withdrawal strategy in retirement. So it's really important, if you're getting paid more as an expat, to use some of that money to actually save and invest for retirement. Or even if you're not getting paid more, but the cost of living is lower, you have to aim, as I've said here, for more than 10%. So back home, a lot of the advice is 10% of your income should go towards retirement. But remember, back home, you've got higher taxes, which is paying for some of your retirement income. So as an expat, you're going to actually have to be a bit more ambitious. Now, what some people say to that is they'll say, well, that sounds good, Adam, but I don't have loads of money to invest. However, you've got to remember the maths. Ultimately, if you start investing sooner, even if you put in less money, you will have more money than someone who starts later in many cases. So I've got an example here. Investor one sets aside $5,000 a year for 10 years in a row. So only $5,000 for 10 years. So $50,000. And then they stop when they're 34, 35. Of course, in the real world, they're probably not going to stop, but let's just imagine this person has hard times after that, but they keep their retirement money in their account. Then person two, though, starts at 35, which is still, relatively young, and they invest $5,000 for 30 years. So they're investing much more money. Yet person one ends up having more money than person two. So ultimately, you're never going to be younger than now. So don't kick yourself if you haven't started saving and investing. However, you've got to remember that if you start earlier, even with smaller amounts of money, you could actually beat someone who starts later and invests a lot more money. And, especially people who wait until they're much older, you've then got to kind of play catch up. So a lot of the people who reach out to me are in their mid 40s, 50, 55, and they panic and say, well, Adam, I should have done more when I was younger, but now I have to be super aggressive with retirement and try to save and invest whatever I can. If possible, try to avoid that. Start at a younger age, and then you're going to be ahead, even if you've only got a small amount of money. Now, the reason why that's so important is Einstein is reported to have said the compound interest is the eighth wonder of the world. So by the eighth wonder of the world, he means that the analogy I would give is if you go up a mountain, it takes a long time, right? Or a hill. But then if you roll down the hill, it's super fast on the way down, right? So that's why compounding, such a potent tool in any investor's arsenal. A third mistake to avoid is thinking locally. Now, what do I mean by thinking locally? Most people, and it's natural, they are reassured by what's familiar. So, for example, if you live close to an Amazon warehouse, you're more likely to invest in Amazon stock. If you work for any company in the world, you're more likely to invest in the stock of that company, even though you're doubling your risk. Because if you lose your job because the company goes bust, you lose your money and your job. So when something's more familiar, we're more reassured by it. So that means most expats are more likely to invest in either their home country or their current country of residence. And one of the reasons for this is we assume it's safer. However, what you've got to remember is if you look at this diagram, 124 trillion of GDP, it's a big world out there. And even countries that we respect, which hopefully is most countries, you can see they're a very small percent of the pie. And, we shouldn't assume the local investments are less risky. And I'm going to speak more specifically about why often they're more high risk in many cases. Now, before going on, there's a good test to actually work out if familiarity bias is getting to you. And it's human nature. We've all done it. I've done it. Everyone's done it in terms of being more familiar with something and then assuming it's not risky. But ask yourself a question. Would somebody from outside your current country of residence or from a different country consider the investment you're doing safe or a good investment? So, for example, would somebody who's an expat living in Latin America or Europe or any region of the world, really, would they consider it safe to put a lot of money in a bank in Nigeria? The answer is probably no. Likewise, even if we say, would a non-British person consider UK property to be a good bet right now? The answer is probably no. It's true to say a lot of non-British people might think that British property is a stable investment, that it might do okay. But the vast majority of people who aren't British would not consider British property to be a really good bet right now. At best, they would think it's so-so, right? So a good rule of thumb is always consider what somebody would say who doesn't have your nationality, who doesn't share the same nationality and isn't living in the same country of residence. If you actually ask them, well, do you think X and Y is low risk? You might be surprised by how they, respond. Now, one of the big reasons, though, why there is familiarity bias, and this is actually a very logical reason, is many people assume that GDP growth and the stock market and asset prices are highly correlated. In other words, if GDP is doing really well and the country is doing really well, their stock market is going to do very well and their real estate market is going to do really well, and vice versa. That is actually a perfectly logical way of thinking. and it makes sense. But in the real world, that's not always the case at all. So, for example, since 2007, the Chinese stock market has been one of the worst performing in the world. It hasn't actually recovered from 2007, but apparently, obviously, GDP growth in China has been fairly good. In the same period, the US stock market, the S&P 500, has done 500% returns, not including dividends. And the tech-heavy NASDAQ has done over 1,000% returns. MSCI Africa and MSCI Emerging Markets have underperformed in that period. New Zealand has had one of the best performing property markets, at least in the 2010s, because many wealthier Chinese buyers and Arab people went into the market. Nobody saw that coming. This year, Europe and South Korea have seen some of the biggest asset price increases in terms of the stock market. Again, those two regions have very low growth. Now, don't get me wrong, though. Don't confuse what I'm saying. That does mean, though, that some of these assets now are quite cheap. Chinese stock markets, MSCI Africa, MSCI Emerging Markets, they look quite cheap now. They might well actually do really well in the next 10 years. Like from 2000 until 2006, emerging markets did very well. So this might be another period where emerging markets do well. All I'm saying is you shouldn't think there's a correlation that it makes sense to invest in one region because the GDP growth is actually doing better. And what is interesting is one of the reasons for that is if you think about it, who have been some of the biggest beneficiaries of emerging market growth? It has been US companies like, for example, Apple. Apple, if you go back 30 years, wouldn't have sold hardly anything in China. Now it's like 17% of their revenue. And if Africa continues to develop well, the same thing could happen in Africa, right? In terms of, you can see here even on this graph, the number of iPhones relative to Android, even though it's still low, it's come up a lot. So in 2018, about 6% of the market in Africa had iPhones. Now it's 13%. So in another 20 or 30 years, who knows what the figures could be. Now, I'm not saying that Apple are automatically going to benefit from the growth in Africa. Again, I'm just saying we shouldn't assume that if Africa does as well as I think it might do in terms of GDP growth, that that's going to mean that African stock markets and African real estate is going to outperform. There's a very good chance that it won't actually outperform. Also, we have to remember that even South Africa, which is the biggest stock market in Africa, is about 1% of the global stock market. So South Africa is about 1%. The whole of Africa, depends how you look at it, is like 3 to 4 or 5%. And smaller markets do tend to be riskier in terms of buying, for example, an investment fund based in Kenya is always going to be more high risk than buying an investment fund based in, say, the developed markets for various reasons. And one of the reasons is actually this reason. So if you're buying US companies, you're buying the world. So even though this says 70% or so of the stock market is the US, if you think about it, if you look out of your window, you could probably see a Starbucks, no matter where you are in the world. Not literally, but you know what I mean. In pretty much every major city in the world, US companies are massive. So you're buying the world. So again, you've got to remember that markets that are more mature also have fewer risks. Now, this is another thing, not factoring in currency risks. So one reason why fast-growing economies can see weaker USD asset prices is currency depreciation. So if we have a look here, this is for 2023. We can see the Lebanese pound, the Argentinian peso, but we can see many African market economies there as well. So, for example, the Kenyan shilling was down 20%. South African rands compared to, say, 2002, 2003 is really weak. And if you think about it, that creates a much bigger barrier. Because, for example, let's say if US stocks are going up by 10%, right? But then in Kenya, you're starting at this point because of the currency devaluation. The companies have got to grow a lot in terms of value to get back up to this level in US dollar terms. And the same thing when it comes to prices in real estate. A big US dollar depreciation or even relative to euro, pound, or whatever can make a big difference. So even if you're making good money in local currency, that doesn't mean you're making a lot of money in US dollars. Another thing related to local investments that people don't factor in is the liquidity of certain assets. Now, don't get me wrong, all around the world, selling property or land or private businesses is not as easy as a stock or an ETF or something which is listed as an instrument, right? You can't just go online and sell your property in a couple of seconds anywhere in the world. However, we do have to remember that in the UK, Canada, US, and several other markets, when it comes to residential property, it's a fairly liquid market. You can, in general, find a buyer within a couple of months in many places. And obviously, if you're desperate and you want to lower the price, sometimes in a few weeks. However, I have noticed that in general, in most markets in the world, liquidity is not that high for property and land and also businesses. So I once met a guy in Cambodia who was boasting to me about the price of his land. But then a few months later, when I met him, he told me, well, I can't find a buyer for the land. So that's another thing. You've always got to factor in how easy is it to actually find a buyer for investments. And in some markets, the liquidity just isn't there. Okay, so number 4 is taking unneeded tax risks. What do I mean by unneeded? At the end of the day, unless you live in a 0% tax country and all your assets are in certain places, you've got to pay tax somewhere in most cases, at least on some assets and some income. However, you don't need to make your life more complicated than it needs to be. So, for example, if you're a British expat living in, well, Africa or Latin America or wherever, if you don't keep many ties to the UK, you can look at the HMRC ties test. You don't have to pay taxes to the UK government in most circumstances. Now, even when it comes to inheritance tax, if you've been outside the UK for over 10 years, you don't have to pay inheritance tax. Again, obviously, this isn't formal tax advice, but if you have British assets in comparison, you do have to put in a tax return and you do have to pay income on the rental yield above a certain threshold. And likewise, you do have to pay inheritance tax on UK assets as a British person, or for that matter, a foreign individual as well. If a foreign individual, whether they're Nigerian, Canadian, American, or whatever, dies with loads of British assets, doesn't have to even be loads, maybe 2 or 3 properties, you could be facing an inheritance tax bill. So unless there's a really good reason to do that, you should think carefully about it. Likewise, US taxes for non-residents, including withholding and estate taxes. The US, if you buy many assets in the US, you also face that risk. Even if you buy certain US assets online, like stocks and whatever, there's withholding tax and so on. In comparison, if you have money in a tax neutral place, which I mean, or what I mean by that is places that don't charge taxes on you directly, it simplifies everything. So I'll give you an example. Let's say you have an account in Luxembourg or Cayman Islands or whatever, and somewhere which is just low or no tax, should I say, and you're careful what assets you buy with the help of an advisor, and you can take those assets with you no matter where you go in the world because it's just an online account, then at least you don't have to worry about the taxes in the Cayman or in Switzerland or in Luxembourg. So if you just have an account in a 0% tax place in terms of they don't tax you on the assets, then yes, you'll still have to consider your local tax position. So if you're a British person living in Canada or Kenya, or you're a Nigerian living in Kenya or whatever, or a Malawian living in Angola, yes, you will still have to consider your local tax position, but you won't have to worry about the taxes on assets. In comparison, if you buy loads of properties all around the world, you do then have to worry about taxes on those assets. Likewise, if you have loads of investments back in your home country, because again, going back to familiarity bias, Many people think, why don't I just send money home? But if you do that, there can be unexpected tax consequences of that. In comparison, if you have a third country account in an offshore jurisdiction, which just means not your country of residence and not your country of nationality, then at least you don't have to worry about taxes on the asset in that particular country. You don't have to worry about double taxation. So it's much more simple for you in that case. Um, so I'm not going to go through all of those things. All I will say is it is possible to simplify your tax situation on assets with the help of advisors. And also a key thing I think about this is it's not just about return on investment, it's also about hassle. In other words, if you're moving from country to country, if all you have to do is update your proof of address every time you move, or even if you're not moving around too much, but you're going to go back to your home country, it's so much easier if you can just update your proof of address with the online investment platform in that tax neutral place, as opposed to having to fill out tax returns in the UK and Canada and all the countries you own property in. So there's a lot of unneeded tax risks that people are taking. Again, I think part of it is familiarity, wanting to send money back to our home countries. Another thing to avoid is there are some wrong assumptions about what assets are safe and what assets are not. So I'll give you an example. If you ask most people who are not investors, if you said to them, what's safer, property or stocks? Most people would say property, probably. However, when it comes to the stock market, if you invest in the whole stock market and not individual positions, it's actually very safe if you do it long term. So, for example, the S&P 500 in the US, if you invest in it just for a year, that's risky. There's a 27% chance based on historical norms you're going to be down. Over 5 years, you're talking about, a 5 to 10% chance you'll be down. But over like 20 years, your chance is very low, to say the least. And it's even lower if you have stocks, bonds, different assets. So if you have a well-diversified portfolio and you just pay in periodically and you do it decade after decade, it's actually very, very low risk. In comparison, when it comes to something like property, as an example, you often have to pick the right location. There's individual risk with individual property. So when it comes to the stock market, you can actually lower your risk dramatically by not picking individual stocks, but picking the whole market. And finally, yeah, I've already mentioned this. Not focusing on portable solutions, not telling your banks and brokerages you've gone abroad. I've heard some people online say, "Oh, you should just not tell your bank you've moved abroad." But the thing is, that's very risky because eventually they're going to ask for proof about that. Also, one day governments could get stricter about that. They could say, "Well, if you kept sending money to your home country and you didn't tell the bank that you'd left the country, does that mean that you're really, not a tax non-resident?" So it's not a good idea. I've met so many people who start panicking when their bank just actually closes down their accounts. So that's a risky move. And there are loads of brokerage accounts you can open when you move abroad. We've helped people in over 100 countries. It's not difficult to find a portable brokerage for expats. I've already mentioned about investing in property back in your home country. In general, unless the return on investment is crazy, you're taking more risk and there's going to be more hassle because of taxes. And even if you don't pay taxes, tax returns and so on, and then risks when it comes to inheritance tax. There's also some complicated things people can also miss out. So if you've got significant assets back in your home country, it's always good to speak to an advisor before you leave because there are certain complex tax rules. So for example, in the UK, there's a 5-year rule on capital gains taxes for UK expats. In other words, if you leave the UK and then you come back within 5 years, sometimes you pay capital gains on certain kinds of assets. So the devil's in the details. So it's always good to actually, seek advice. the final point is UNFCU. A lot of UN expats have told me it's okay for banking, but they've tried the investment services or the affiliated third-party investment services. And, obviously there's good and bad things about all providers, but in general, they didn't have that many good things to say about it. So again, this probably comes back to familiarity. Obviously, UNFCE seems very familiar if you work in the UN, but it's good to seek alternatives as well. Now, let's talk about opportunities, though. So we talked about some of the mistakes, but let's talk about opportunities. When you're abroad, often you can gain assets that you can't get back in your home country. And the reason is, back in your home country, often you have to be a certified high net wealth individual to get access to certain investment opportunities. When you're abroad, it's actually easier to get access to things like pre-IPOs where, you don't have to have 5 or 10 million in liquid net worth. Enhanced income options, downside protected options, capital protected options, individual corporate and government bonds. All these things are usually easier when you're abroad because you don't have the whole issue of needing to certify yourself as a high net worth individual. Obviously, it depends where you move to abroad, but in general, it's easier to get access to more sophisticated investments without having to, invest millions. Now, when it comes to options, as mentioned, you do have the opportunity sometimes to get tax-free growth. Again, it depends where you live. It depends on many factors, but you do have that opportunity with certain types of assets if you live in certain countries. Also, there are nationality-specific opportunities you might want to look at. So, for example, if you're a UK expat, you can pay into national insurance as an expat for a very small amount of money per year. There are political risks with that because obviously there's aging populations in most Western countries, but that's a specific thing for expats that some people take advantage of. Also, there are more flexible pension-like solutions than back home with fewer political risks. As mentioned, there's low hassle portable investment plans that can follow you around the world. Also, the second point is an interesting one as well. If you're planning to repatriate, there are often interesting investment options as well. So I'll just give you an example. For British people and Australian people, portfolio bonds, we don't have to go over on this presentation what they are, but they're a form of investment-linked insurance, have certain tax benefits for Australians and British people. So, for example, for Australians, if you've held the bond for over 10 years and you've lived abroad for that time and then come back or go back to Australia, you can qualify for certain tax reductions. Likewise, British people, there's a 5% rule where if you go back to the UK, you can withdraw 5% per year. But again, obviously, these are technical topics, so I don't have time to go into the technical details on this webinar, which isn't formal tax advice. But just be minded that as an expat, there are certain opportunities you can take advantage of. So, for example, if you're a British person or Canadian or whoever you are, and you think, you know what, in 10 years, I want to go back to the UK or Canada, it's always worth speaking to an advisor and thinking, well, how can I repatriate that money in the most tax efficient way? What options do I have beside tax, which could be good for my financial situation? And finally, what I would also say is when it comes to retirement, obviously focus on the obvious things like personal preferences, but also healthcare, also maybe taxes. But when focusing on retirement planning, look at the living cost today versus tomorrow, and look at the inflation rate, including the healthcare inflation rate. So, for example, if you are planning to retire in a developed country, nobody knows the future inflation rate, but it might be fair to assume that the inflation rate is likely to only be 2 or 3% per year long term. So if you're going to retire in Japan, for example, which has a falling population, again, no one knows the future inflation rate, but it is a fair assumption to say, well, Maybe inflation at most is going to be 2 or 3% per year on average in US dollar terms. But if you're planning to go to an emerging market, inflation might be 5%, 6% or more if the country keeps developing. But also factor in the healthcare inflation costs, so the cost of health insurance, and try to work out, okay, in my 70s, 80s, 90s, how much might I need adjusted for how much I have, how much is the inflation rate, and many other things. And again, professionals like ourselves can help you model those things. Now, a model isn't perfect. Nobody knows for sure the future inflation rates. Nobody knows for sure what asset prices will do. But if you model it, at least you've got something to actually aim for. And you could be conservative and aim for a bit more than the model shows you. So in conclusion, really, I would say portable investment solutions are essential for expats and high net worth individuals and internationally minded people. You need to take your investments with you. You don't want to be in a situation where every time you leave your country or every time you live in the country you live in, you've got to close down investment accounts. You don't want to be in a situation where you've got to lie to your bank essentially and say you're living in your home country. You want to have a situation where you've got a portable investment platform where all you have to do is inform that investment platform that you've moved country. And it's not just for return on investment, it's also for hassles. You don't have to do as much compared to having multiple properties in multiple places. Higher GDP growth won't always translate to better expected asset prices. So I am very optimistic about the GDP growth in most African countries in the next 30 years, but that doesn't mean I think that stock markets or real estate will do better in those regions. In the last 20 years, Asia has done very well, especially China and India when it comes to GDP growth. But that certainly hasn't translated into better returns in the stock market compared to US markets. It's important to be diversified there around the world. There's nothing wrong with having some assets on your investment platform that are focused on emerging markets and some assets for developed markets. But you want to be diversified. It's better not to assume that just because certain countries will do better economically, that will translate into better growth. And expats usually need to save more as a percentage of income than those, back home due to the lack of compulsory savings. So 10% might be okay for those at home because of pensions and so on. But if you're not paying tax back home, you probably got to aim for a bit more. This QR code should be working. So if you want to book a meeting with me and my team, you can scan this QR code. Here are my details in terms of my website, my email, my WhatsApp.